Hello class, welcome to our second review session of chapter 3. So this will be a review of a manufacturing company using job order costing. So remember, when we talk about job order costing, our concern is really about overhead because simply speaking, with a job order cost system for a manufacturing company who's say making furniture, they already know how much direct materials are in that job and direct labor is in the job. So it's simply overhead we are concerned about allocating. So in this problem, which is problem number 6, 7, and 8, so a continuous problem, it's on page 150. This company makes swimming pools, and they are custom pools. At the beginning of the year, and I stress, at the beginning of the year, their budget for overhead being things like utilities, depreciation on the building and equipment, any real estate taxes, the plant manager's salaries, the cleaning services supplies, all of that overhead. Their budget is $1,400,000 for the year. They are looking at 3 different ways to allocate that. Choice 1, using direct labor hours to allocate overhead. Choice 2, use direct labor cost to allocate overhead. Choice 3, use machine hours. So at the beginning of the year, again, they know their overhead budget's $1,400,000. They expect to have 50,000 hours of direct labor. So $1,400,000 divided by 50,000, that means their cost per direct labor hour, again, this is their budget, $28. And if they use direct labor cost, it will be 1.4. If they use machine hours, their cost will be $35 a machine hour. And we give them, we're their consultants, and we give them this information and they say thank you very much. And we appreciate your work. We'll see you at the end of the year. So the end of the year comes. And we find out that they actually had 51,700 hours of direct labor. So, how much overhead would they have allocated if they used direct labor hours throughout the year? $28 times 51,700 hours, $1,447,600. So that's the first possibility. If they had used direct labor cost, well, their direct labor cost, their actual for the year was $1,020,000. So 1020 times 1.4, had they used direct labor cost, they would have allocated $1,428,000 for overhead. And for machine hours, they actually ran 39,500 hours of their machines. So they would have allocated $1,382,500 had they used machine hours. Well, they tell us that it turns out their actual overhead was $1,425,000. That's what they actually spent for overhead. So question, which one would have been the best? Well, what number is the closest? Direct labor cost. So that would have been the best allocation method. Now in the problem, they tell us, well, that's fine, but that's not what they used. They actually used direct labor hours. Okay, so let's take a look at that. We'll go back and look at a T account. 1,447,600. So all throughout the year, and by the way, this is our inventory overhead account. So throughout the year, all the costs for overhead, that totaled $1,425,000, went here. And all the credits for that allocation of overhead went here. So it's at the end of the year. Well, first of all, they over allocated their inventory because we actually now have a balance. We have a credit or negative balance of 1,447,500 minus 1,425. So $22,500. Well, first of all, we can't have negative inventory. The lowest number is 0. So we need to get rid of this. I'm going to keep this number here because I'm going to use that as an example. So I'm going to leave that. But I'm going to show you what the journal entry will be to fix this over allocation. And I know how much you all enjoy working with debits and credits, but nonetheless, it is one of the few times in this course we will. So to get rid of that credit in inventory, we need to debit it. So we're going to debit inventory overhead. I'll just shorten it to say inventory, and credit the only account that goes with inventory, and that's cost of goods sold for $22,500. And that then will fix at the end of the year the over allocation. Now that might not be such bad news for the management of the company because by crediting cost of goods sold, they're actually increasing in net income. But let's consider, and of course I realize this is not part of the problem, but I just want to show you how this would work. What if they had used machine hours? So this number here would have been 1,382,500. And then they would have had a positive balance in the inventory account. 1,425, so 1,425,000 minus 1,382,500 of $42,500. And you might say, well, why is that a problem? Well, here's why it's a problem. Because they have no inventory at this point. These are custom jobs. There's nothing. It's New Year's Eve and the plant is empty. So this is non-existent. They have no inventory. So how are we going to fix this problem? Well, this is a debit balance, so now I have to credit inventory by $42,500 and debit cost of goods sold. And that, my friends, will be unwelcome news because that's going to decrease their income and maybe year-end bonuses. So this is just a good example of why it's so important to accurately budget for the year, and how with job order costing with a manufacturing company, we need to settle up this account at year end. So I thank you all for joining me for this second review session, and I hope you all stay well and have a great day. Thanks.